Hi everyone, it's Tom Buck from the Calder Group here again. Been about 2 weeks since we last did a video update on the markets, investments, things that you need to be aware of. Happy to say I'm joined by Alex from Blackfinch again. Hi Alex.
Morning Tom, how are you doing?
I'm not too bad, how about yourself?
Good, yeah, very good, thank you, very good indeed.
Good. I have noticed we're both getting a little bit rough around the edges now as we go along. I don't want to look back at where we started this about 4 or 5 weeks ago, but I can't decide. I don't know if you're the same. Do I rush on when lockdown is out to mountains and go hiking, or do I rush to a barber's and try and look human again?
Yeah, I think yes, I'm missing the barber, I think it's fair to say. So not sure how much longer this hair can carry on for, but there we go.
Absolutely. I've noticed a few people on Facebook are now shaving it all off, so I might be tempted. Crew cut time, 1970s, punk rocker, here we come. But we'll move on
might need to
rapidly
come to that, yeah.
yeah, we'll do another one on beauty tips and hairstyles at a later date. I think we'll concentrate on what we're good at, which is the financial advice side, if that's all right with you.
Yeah.
Okay, it's been a while since we spoke. We've seen, really, I think it's fair to say, the markets have been fairly stable. They've not been too dramatic. I'm going to throw a little wobbly in here. I know you weren't probably expecting me to ask it, but we've woken up this morning, the BBC headlines, stock market falls by almost 2% within minutes because of oil price collapse. We had OPEC and Russia last week, I think it was, or 2 weeks ago, came to an agreement that there were cut production, that would keep prices stable, and we're now seeing at record lows, or lows we haven't seen in 2 decades. Can you explain what's going on with, or is it just purely oversupply and now demand has absolutely come to a grinding halt? And what impact do we think that's going to have on the main markets and people's investments?
Yeah. So effectively, on your point about OPEC, so the agreement, obviously, on the face of it was good news, but unfortunately, it was a case of a bit too little, too late. Unfortunately, by the time they'd actually come to the agreement, global demand for oil had dropped so severely that the cut in production agreement was not nearly enough to offset this. We're now in a sort of position where we're running out of places to actually store this oil that's being extracted. Unfortunately, it's not as the case of sort of turning off these rigs like you could turn off a tap. It unfortunately doesn't work like that. So the rigs are still on stream. Production is slightly reduced, but frankly, because consumption is so low, there is simply nowhere to store it. So these storage facilities are nearing or almost at capacity. And last night we sort of saw futures tip into negative territory, which is effectively where producers are paying people to take it off their hands. So we haven't ever really seen that before. There's a couple of technicalities in there, and actually the prices have since recovered and stabilized a little bit. But of course the market is a bit shocked by that, and hence we've seen this kind of 2% decline in markets this morning. So actually, though, having said that, 2% in sort of recent volatility terms isn't much in a day, but nevertheless, it's still taking note of that. So yeah, that will materially impact sort of indices like the FTSE 100, for example, where oil companies are sort of a heavy sort of weighting and constituent there. And again, we are focusing on those areas, but interestingly, the individual oil companies themselves haven't fallen quite as much as we would have expected to. So there sort of is a bit of resilience around there. But again, it's an evolving situation and one that we're watching. But yeah, we are really in unprecedented times with the oil market at the moment.
Yeah, again, like you say, a 2% drop in the markets, quite frankly, what we've had over the last few weeks is neither here nor there. I was a bit amazed it even made the front page of the BBC website. Yeah, it's just, I presume it's like everything at the moment, it's that panic, it's that sort of, oh my gosh, what does this mean? No one really having an answer, and so the markets just do what they normally do, which is a small fall until I breathe, relax, and think it through.
Yeah, absolutely. Yeah, exactly right.
Okay, so in terms then of where people are, because I think now I think we're into week 3 or week 4 of lockdown. no idea. I'll wait to be
Yeah.
told. I'll ask Alexa later. She's the only other person I can talk to apart from the family. So we're getting through that period where people, and I'm starting to see it again on social media, businesses are opening up. They're using technology now. They're doing collections. They're doing all kinds of things to start trading. So people are starting to return to normality. For the clients that we've got, all the people out there who have a lump sum of money that they want to invest but are scared to invest because we don't know what the future is going to be. We don't know if it's going to be the end of May, end of June before out of lockdown, and what procedures are going to be. If you have a lump sum of money, are you best just going like, okay, here we go, we'll go for it? Or is the best option to go, I'm going to drip feed this in over the next 12 to 18 months to ride out the peaks and troughs of the market?
Yeah, that's an extremely popular question at the moment, and we're being asked that a lot by sort of advisors and clients at the moment. Is drip feeding the best, or is one sort of lump sum initial investment the best? So we can really look at it in two ways. Firstly, I suppose, depending on the underlying client's behavior and attitude to financial markets will drive this. So essentially, if the client was looking at investing the full lump sum in one go, that client must be prepared and be comfortable knowing that they could quite quickly and easily see potentially 15% or more loss in the short term. However, the flip side of that and the positive means that they will capture every single positive upside day from that point going forward. So if they're investing for a 3-5 year and out time horizon, they will capture every single up day with their full invested capital, if that makes sense. And the second piece really was about some historic modelling. And in fact, we've done some work on this, and I'll send you through some data on it, which, so feel free to share it with your clients. But effectively, it looks at hypothetical situation. If a client invested on the eve of the global financial crisis of 2008, so arguably one of the worst points in time to invest, so just before the markets really started selling off. If they had held that investment to the end of calendar year 2019, they would have been up about 35%. So on about £100,000 portfolio, they'd have been up about £35,000. So not a bad outcome. If they would have missed just the best 10 days, so i.e. come out of the market for 10 days or tried to time going back in by just 10 days, so missing just of those 10 best days, that pot would only be worth £99,000 by the end of calendar year 2019. If they would have missed the best 30 days, that pot would then only be worth £71-ish thousand. The point is that should illustrate the long-term damage that missing out on the market sort of upside and those market jumps, if you like, the long-term damage that can do to the investment pot. So history has sort of told us that really the best way to invest is buy and hold strategy. And I'm thought this very cliched and overused phrase, but it's time in the market, not timing the market, that is important. So again, yeah, very happy to send that data through to you and see. But effectively, if a client is going to invest a lump sum right now, timing the bottom is near enough impossible, and that client must be prepared to see short term, a notable fall, and just have that prepared in their mindset to think, okay, I'm going to take the short term pain for the longer term reward over time.
Yeah, that's right. And yeah, if you send that information across, Alex, we'll put a link somewhere around the video, depending on how people are watching this, to so they can see that and look at the data. And absolutely, 20 odd years in the industry, you see it time and time again. Like you say, it's holding on, it's trying to work it through. I've yet to find a fund manager who can really call the bottom of the market. It's so have enough money for the emergency over the next 5 years and for replacing the car, fridge, whatever, and invest what you can afford to just sit, forget about, and let it run.
Yep, absolutely right. Yeah, exactly. So have that cash buffer, as you say, the sort of for the rainy day fund, if you like, and obviously something they can discuss with yourself as their financial advisor. So that's totally separate. But yeah, the investment pot, if you've got capital you can commit to the markets for the longer term, then yeah, that's right.
Okay. Now, within the Calder Group, we do a lot of work in terms of succession planning, which means we deal a lot with trusts and trustees. Obviously, in terms of trustee investments, they're under slightly different pressure that they must get the best possible return for the right amount of risk for the eventual beneficiaries of that trust. Is there anything you can say to trustees at the moment, or are we talking the same kind of language of actually look at the timescales, look at investment, look at the asset allocation? Is there anything to say to trustees, this is the best way of investing at the moment?
Yeah, I mean, we've spoken to a couple of trustees recently, actually, who themselves may have set up sort of trusts for the benefit of their family. So they might be more elderly members of the family setting up these sort of trusts for their beneficiaries. So typically, their risk appetite themselves would be sort of more cautious. And actually, we're starting to see some trustees adopting a higher risk investment approach, if you like, so i.e. investing into this market volatility, which you wouldn't typically associate with a more cautious and defensive client. But their mindset is they're investing for the longer term benefit of the sort of beneficiaries of that trust. So yes, we are starting to see some trustees sort of look past even their investment timescales and more focus on the beneficiaries. So yeah, we are starting to see trustees sort of take that into account and again look at the longer term returns. Going back to our sort of earlier point, I suppose, looking at sort of the longer term return potential of their investment and weathering that short term volatility.
Okay, and for those trustees where they're looking for income, obviously we're seeing dividends drying up and the regulators persuading lots of companies, certainly in the financial sector, not to pay dividends, and companies are sort of restricting that to build their cash balances up. Again, is there anywhere that they can look for income, or is it just a short term, we might need to use capital to build up the cash within the trust?
Yeah, I guess it depends on the income level they require. But however, we adopt, as you well know, so that globally diversified multi-asset investment approach. So yes, certain sectors in the FTSE 100 are going to see substantial cuts to dividend income, but there are lots of other assets out there in the market that can still pay an attractive level of income. And by attractive, I mean well ahead of inflation and certainly ahead of that you would achieve at the bank or on deposit. So again, yes, certain areas that will make the headlines and sectors, particularly in the FTSE 100, will see cuts, but that does not mean that income investors, there's nowhere for them to go. Yes, they will need to get used to a sort of a slightly lower level of income, but bearing in mind, obviously, inflation is particularly low at the moment, and so therefore our interest rates as well. So it kind of all fits into that. But yeah, some clients who need particularly high levels of income, yes, might need to start looking at dipping into some of the capital. But yeah, for the general income investor, there are still options out there as well.
Okay, no, that's great because obviously, as we say regularly when we do these presentations, the press don't exactly give a positive view on things. And talking of which, particularly with the headlines we've seen over the last 24 hours, one of the things I wanted to go through is when we were talking about doing this game, we were seeing a huge up movement in the share prices of the travel industry. And we were seeing that starting to recover. I think there was perhaps a false belief that we could see an incoming, the travel industry, the leisure industry is going to boom again. Since then, of course, we've today seen Virgin Australia go into protective bankruptcy. We've seen Sir Richard Branson offer his Necker Island as a way of trying to generate that 500 million government loan that he's after. Are we seeing just in general people grabbing hold of any good news and running with it out of control? Or is there actually something sensible that maybe I'm not seeing and my clients aren't seeing that the news is hiding that is pushing these unpredictable growth areas?
Yeah, I think this is a classic example of market overreaction, both on the down and the upside, and I think the travel and leisure sort of industries are key examples of that. So if we just take some names, for example, I mean, we've been looking at stocks like obviously EasyJet, Carnival, JD Wetherspoons, and Whitbread. Who own the Premier Inn hotel chain. Now, these companies really from their peaks prior to the sort of virus outbreak have fallen 70–80% in some cases, and that's their sort of peak to their trough. Now, since that trough, which was I think mid to late March, we've seen those stocks recover in value by between 30, 50, 60%. So quite wild swings in both directions. And unfortunately, I think, as I say, this is a case of classic overreaction both on the downside. So really, should they have fallen 70, 80% in the case of some of those names? And actually, do they therefore justify that kind of bounce back? So I think the market is really struggling to price those. Yes, there's an element of, there's signs of lockdown easing in some European countries. But I think it's too early to say. So I would say that, yes, the market is overreacting now on the upside and the potential to get these companies sort of back on track. And I think, yeah, it's an area where overreaction has certainly occurred here.
Yeah, and there's probably going to be other areas because everyone, and we've talked about the boom in tech. We're using Zoom at the moment to record this, and that has seen a tremendous growth in share price because everyone has been talking about Zoom, apparently all because Boris Johnson is the world's greatest figurehead for promotional material. And I presume we're going to see that carry on for a little while as the new normal and the new economy comes out.
Yeah, exactly right. So we're quite encouraged to see now that a lot of our holdings in that tech space are actually in positive territory since the start of the year. So actually, even through all of this virus outbreak, are now higher than they were on the 1st of January. So I think that's testament to the reliance on these companies and their future growth potential going forwards.
Yes, I've read somewhere that I believe Disney Plus, which got its timing almost perfect, has actually achieved in 2 months their subscription figures they were anticipating in the whole 9 to 12 months of left of 2020. So it'll be interesting to see how that carries on and actually how many people get to a point where they go, you know what, I don't want technology quite as much. It was great while I couldn't get out. There might be a correction then downwards in some areas of things are slightly overpriced.
Yeah, absolutely. I think in some of those services and areas like the Disney Plus example, yes, there is a risk of that. Children back to school and parents back to work, etc. Will there be the need? So again, could potentially be, but there are certainly other core areas of the technology and telecommunications sectors that are sort of establishing quite long-term trends now. And this virus outbreak and social distancing that we've had to adopt across the world has really accelerated that growth trajectory. So I think there's some sort of core areas there that will continue to see quite attractive returns.
Okay, one final question before I let you get on with no doubt a busy afternoon. We've talked previously about asset allocation, and it's something I've preached for a long time of having the right asset allocation as equities go up, bonds come down, that kind of approach. It's protected certainly on the downside. So we saw the markets fall 25–30%, and yet average portfolios for ourselves were around about 8 to 15%, depending on the level of risk that our clients were taking. As we're seeing the market settle, as we're starting to perhaps see the world starting to move out of lockdown, as you say, some European nations are starting to allow some movement with social distancing involved. Is there an argument for saying, let's forget that asset allocation for a while, let's just throw everything into equities when there is such potential for good returns over the next whatever time frame you want to look at?
Yeah, so I would say we would never sort of stray away and forget the asset allocation really. So we work within tolerance and risk sort of boundaries there. So we have been, I guess, sensibly adding to equities and still maintaining that diversified approach, because unfortunately we are by no means out of the woods in terms of the uncertainty that we're in at the moment. But yeah, your point about multi-asset, sort of globally diversified portfolios is absolutely key. And looking at, say, year-to-date figures, the FTSE 100 is down around 22%, I think. And like you say, our sort of cautious and balanced portfolios are down between 8 and 9%, so significantly less than the FTSE 100, which is a classic example of diversification doing its thing. So yeah, as I think we covered on maybe one of the other calls, we are adding to equities in certain areas where we think that actually, as I say, those sort of more established trends are playing through, and yet the valuations are at fairly significant discounts to where they were at the start of the year. So we're adding to places like that. But yeah, we're not in full-on risk mode at the moment, no. So we're still sort of maintaining healthy exposure to alternatives and bonds and more defensive assets. But yeah, the portfolios do retain a good exposure to equities to capture on that upside as and when things become clearer.
Okay, no, I mean, to be honest, it was a question almost tongue-in-cheek, because I knew the answer, and it's, if you were saying, yeah, we're about to throw everything into this high-risk, high-return stock, then the clients who use your portfolio will be, shall we say, moving to slightly different positions quite quickly.
I don't think, yeah, you wouldn't be very impressed with that. Yeah, quite rightly.
Yeah, and it's always having in the mind when you're investing, it's that long-term view, and yes, it's that protection when it's the downside, but also being aware that, again, we come back to what we said earlier, we can't time the market. We don't know when things are going to happen. We don't know what's going to come out. There may be someone who announces in the next 2 months that they have got the coronavirus vaccine and they're going to produce enough in 3 months and it works, and then markets rally, and then we find out it's not quite what they say it was going to be.
Yeah, exactly. So I mean, you've got the, we saw it 2 or 3 trading days ago. I think Gilead had been trialing some vaccine in the US that has shown really promising signs for some of their patients. And again, that stock was rallying quite hard, and investor sentiment was buoyed by that. Now, stories like that will help the market, but equally, we could just as easily see lockdown extended across Europe. We could see reinfection risks and reinfection rates really spiking as and when lockdown is eased. So again, that would really hurt sentiment in the market. So we could just as easily see it rally as we could see it sort of come back a bit. So again, that's why we're still not on that risk on mode just yet. It really could go either way at the moment.
Yeah, okay, it makes perfect sense. Alex, thank you very much for your time again. I'm going to let you go and see what is happening in the world. Donald Trump will be waking up very shortly, and I'm sure tweeting something that will have an impact to keep you occupied for 20 minutes or so.
Yes, I'm sure he will, yes.
But no, thank you for your time again, and we'll carry on. So if for those who are listening to these videos, paying attention and picking up, we'll carry on doing that, looking at what's happening, trying to make sense of the news, and actually convert that into something that is meaningful for understanding how investments are performing at the moment and what the future may or may not look like.
Yeah,
perfect.
All right, yeah, well, thanks very much then, Tom.
All right, Alex, have a good afternoon, and thank you for your time again. Much appreciated.
Okay, cheers. Bye-bye.